Transfer credits is the total amount received by the creditor. Those need to be the minimum payment from the month before or more. Also, let's say you have a payment due for $30 and then you make a merchandise return for $60. Just because you returned merchandise that was worth more than the payment, that doesn't mean that you don't owe the payment. You still have to make a payment. New purchases is any new purchases made. It's like a sum of all of the purchases you've made during the current billing period, all added up. Late charge only shows up if you actually paid the previous month late. So if I paid April late, my May bill is going to have a late charge on it. Finance charge is the cost of using the card. That's the interest on the carried over balance. So again, if you pay it off at the end of the previous month, there is no finance charge. And then the new balance is the amount that you currently owe total. So it's the previous balance minus the payments, plus new purchases, plus any late charges, plus any finance charges. Okay, so the minimum payment is the lowest payment the credit card company will accept without penalty. Now, for some companies, they'll take a less payment, but they'll charge you like a late charge or penalty, and then some companies won't accept it at all. They'll just send it back to you. You have to pay the minimum. In any case, you don't want to not pay the minimum because there would be some sort of consequence, and it's not good for your credit. The average daily balance, we've been calculating that. It's the average amount owed per day in the billing cycle. The number of days in a billing cycle, that's the number of days in a billing cycle. APR is annual percentage rate. And then the monthly periodic rate is the annual percentage rate divided by 12, and this is what's used to calculate your finance charge. We've been doing that as well. This is a sample credit card statement. They don't all look like, the formatting may not be exactly like this, but they'll all have the same information. You have your customer name and address on there. There'll be the account information, which will include account number, a billing date. This is the date the bill was processed. It's also the end of your billing cycle. Okay, and then you have a payment due date. You'll have a list of all of your transactions. These are all of the debits and credits, so everything that you buy and everything that you pay. Payments, remember we talked about this, show up with a negative credit. Debits are purchases, which are positive, and then credits are payments, which show up as negative. Then you have a summary section. This is usually, it could be at the top of the statement or at the bottom of the statement. It's not like thrown in the middle. It's always at the front or the back. And that's where you see all these things that we were just talking about and defining. We have the previous balance, your payments, new purchases, late charge, finance charge, new balance. Okay, the new balance is the first column minus, plus, plus, plus equals. So you add up all the charges, subtract your payment, and you get your balance. Minimum payment due. Credit card companies will have a way that they calculate this. They'll either have a percentage of what you owe or some set amount, and then they'll say whichever is greater. Or so, like, if your percentage of what you owe is only $4, they're not going to send you a bill for $4. They're going to send you a bill for the minimum, like a 15 or 10 or whatever they say that payment is. So it'll be a percentage of what you owe or a set charge, whichever's greater. Unless, of course, your amount that you owe is less than $20, and then it's just however much you owe. You have your total credit line. This is the maximum that you're allowed to charge. And then you have your total available credit, which is your credit line minus your balance. That's how much you've left. Then they have your average daily balance, the number of days in your billing cycle, your APR, and your monthly periodic. And that's all on your statement. Section. Okay, so we're looking at her summary. And we're going to explain how the new purchases amounts was determined. Well, I kind of already did that. We took the purchases. We've got gift shop, pizza, department store, and bookstore. So they added up all of the purchases. And there were 4. Okay. And then the new balance, we talked about this too. The new balance is the previous balance minus the payment plus the new charges or new purchases. I'll put both. Plus any late charge plus any finance charge. And that gives us the new balance. Okay. Here we have a credit card summary. Okay. We have previous balance, payments, new purchases, late charges, finance charge, new balance, minimum payment. This guy, Pasquale, has a $15,000 limit on his credit card. Here's his summary. What's his available credit? Well, available credit is equal to the credit limit minus the new balance. So that's going to be 15,000 minus, here's our new balance, which is going to be 14,636.52 that this guy could still spend on this credit card. Our summary section, she agrees with everything. She says, okay, yeah, that's good, 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 good. Nope. So we're going to figure out the error. So from what we know, we take this 1748 and we subtract 100. We add her new purchases, we add the late charge, and we add the finance charge. And what we come up with when we do all that is 2476.15. Okay, well, what error would cause that? It's $100 off, right? If I added 100 instead of subtracting 100, I would get 2576. Hold on, I might have lied about that. Nope, that would have been 2676. Sorry, they didn't add, they didn't count the payment. Okay, so if we didn't have that payment, then it would be, so what they did is they did not give her credit for the payment. The finance charge is based on the average daily balance. And to find the average daily balance, one of the easiest ways to figure that out is to use a credit card or credit calendar, because that lets you figure out how many days your balance was each amount. It's easier to do it that way. So I'm going to run through an example quick, like show you how to, show you the example quickly, and then we'll do another example where we actually go through and do it ourselves together. So we have this statement here. Okay. What we do is we take what's called a credit calendar, and it's you can draw your own, or I've found one online. And it has these spaces in the bottom corner. That's where the date goes. And there are 35 days here because it's 7 by 5. Now, she has a 31-day billing cycle, so you would cross out the last 4 days because you don't need them. Okay? So once you've blocked out the days you don't need, the extra days, then you go through and here, this is the 13th. I find November 13th is her billing date. And I start at the bottom with 13th and count backwards. Because this is the last day of her cycle. And we don't know what day it started. We know what day it ended. So we go backwards, 13 to 1, and then we start into October and go backwards like that. And then after we do that, we look at all of her charges and we add those to the days, charge all the transactions. So every charge and every payment, we put them on the day that they happened. Okay, like I said, I don't expect you to write all this down. Then you say, okay, here's her previous balance, and we write her previous balance across all these days, or you can write it and then like draw an arrow until you get to the next transaction so that you know this many days, it's this balance. Then you add in the $67. See how that gives us a new balance? And we bring this across to here. Then we're going to add in the $55, which brings us across to here. Then we subtract the $160 because that's a payment. And this tells us all of our balances. We have, I'll use the same color. We have one balance that goes this long, another balance that goes this long, another balance that goes this long, and then a final balance that goes that long. Okay, so it tells us how many days were each balance. So you count 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So she would have had 11 days at 8, 29, 30. And then you go 1, 2, 3, 4. 4 days at 8, 96, 30, etc. And we use that to find the average daily balance. Divide it, here's her average daily balance. So like I said, we're just quickly going through this. We'll actually do one. So we've got our average daily balance, which is 854.46. I'm going to write that down. Did I write that right? Yeah. Okay, we come back here. Here's her monthly periodic rate. So that's what I'm going to use for monthly periodic rate. Darn it. Oh, I still have it right here. 1.415%. So to find her finance charge, I'm going to do the average daily balance times the monthly periodic rate. So 854.46 times 0.01415. And that's going to give us $12.09. Okay. That's the finance charge, yeah. So we're trying to find the finance charge, the new balance, the average daily balance, the monthly periodic rate, and the total available credit. All right. In order to do any of that, the first thing we're going to have to find is the average daily balance because we can't find the finance charge without that, and we can't find the new balance without the finance charge. Or actually, I guess the first thing we find is the month. Well, this is first. These are second. So we're going to go to a credit calendar, okay? And what we're going to do is I'm going to be bouncing back and forth between the two. If we look, her billing date is May 18th, and she has 31 days in her billing cycle. This is 35 boxes, so I'm going to cross off the last 4. I don't need them. Okay. This is May 18th, and I'm going to start counting backwards. Okay, so I just put 5-1 there. So that's May. And then there are 30 days in April. So 30, 29, we're still counting backwards. Do you guys know the poem to remember how many days are in a month? No? To May 18th is what ended up happening. So once we've done that, we come in and we look at the payments. So she had a payment on June 18th, April 18th, there's a payment of $75. So I'm going to go on the 18th of April and I'm going to write minus $75. Okay. April 20th, there's target is 128.36. So I go on the 20th and I'm going to put plus 128.36. Okay. April 28th is Publix for 56.83. So on the 28th, I'm going to put plus 56.83. And then May 3rd, Kohl's for 47.33. So I go to May 3rd and I put plus 47.33. Okay, so these are the new transactions. Minus for the payment, pluses for the charges. Okay. Then I start with my previous balance. So I go, here's my previous balance, 576.32. I'm just going to write it off to the side because I'm going to do subtraction right away. Okay, so 576.32 minus $75 gives me 501.32. Okay, and then it's going to stay 501.32 here. But then I'm going to add 128.36, so it becomes 629.68. And it'll say 629.68 until I get another transaction. Now you can write 629.68 on all the days, or if you want, you can do some other kind of notation to let you know that all of these days are the same. Okay, depends on what makes the most sense to you. But when I get here, it's going to change again because I'm going to add 56.83, which will give me 686.51. So if you want to write it every day, you can. Until you get another transaction, 47.33, which will bring me to 733.84. And I don't have any other transactions for the rest of the month, so it's going to stay 733.84 until the 18th. Okay. Now, there's a lot to look at, so sometimes it's nice to do something like take a highlighter. Okay, these 2 days are the same. And then these days are the same. And then these days are the same. And then the rest of these days are all of this. Or you can alternate between colors, or you don't have to do that at all. It's just, whatever will make it visually easier for you to count the number of days at each balance. But what we're going to do is we're going to find the average daily balance. So what we have is we have 2 days that it's 501.32. Okay, and then 1, 2, 3, 4, 5, 6, 7, 8 days that it's 629.68. And then 1, 2, 3, 4, 5 days that it's 686.51. And then 16 days that it's 733.84. And we're going to take all of that and then we'll divide it by 31 days because that's our billing cycle is 31 days. And I'm hoping that my calculations were correct when I did this a few days ago. Okay. And I'll divide all that by 31. So I get 21214.07 divided by 31. So my average daily balance is 684.32. So all of that was to find our average daily balance. So we're looking for A, B, and C, right? And D and E. We found C, which was 684.32. Did I write that right? Yeah, 684.32. Okay. D, our monthly periodic rate. We need this to be able to find our finance charge. So we're not actually able to go in order A through E on this. We have to kind of skip around. So to find D, it's going to be our annual percentage rate divided by 12. So I get 1.6%. So that's 1.6%. That's APR divided by 12. Yeah. You get 1.8? Okay, hold on. Yep, me too. Okay, I'm switching calculators. Apparently my ancient calculator no longer knows how to divide. It's sad, really. Okay, 1.8. All right. So we've got our average daily balance. We've got our monthly periodic rate. We can use those two things now to find our finance charge. We can do A. So we take our, bless you, times our annual or monthly periodic rate. And I'm going to have to recalculate this one too. I get 1232. Okay, so that's our finance charge. Now that we have our finance charge, we can find the new balance. And so the new balance is going to be the previous balance minus the payment plus the new purchases plus a late charge, but there was no late charge, so that's 0, plus the finance charge. So 576.32. So I get 746.16. The new balance. And so the formula for the new balance is right there. So back in the last section. So we take the previous, subtract the payments, and then add all the other charges. And then finally, E is your credit line, which is 2,000 minus the new balance. So we get 1253.84 that you have left to spend. Doesn't mean you should, though.